Good day, everyone. In the realm of economics and investing, understanding the underlying mechanics is crucial. Today, I want to shed light on the misconceptions surrounding recessions and guide you towards strategic investments that can help navigate the complexities of the market in 2026. When you study history carefully and look at the patterns that repeat over centuries, you begin to see that economies operate in cycles. These cycles are driven by debt accumulation, productivity, monetary policy, and human behavior. Right now, the United States is in the later stage of a long-term debt cycle, and the implications of that are critical for anyone trying to navigate the years ahead. Most people tend to focus on the short-term noise of the markets, but what's happening underneath the surface is far more important and far more dangerous. We are at a point where debt levels are rising faster than income, and that is unsustainable. The government continues to finance growing deficits through increased borrowing, which is pushing national debt to historic highs. At the same time, productivity growth is not keeping pace, which means we are not generating enough economic output to justify or service the increasing debt burden. Eventually, that becomes a self-reinforcing problem. As debt grows and interest payments on that debt increase, the ability of the economy to reinvest in productive uses is diminished. One of the things that history teaches us is that when countries borrow excessively, they eventually face the consequences. Those consequences often come in the form of higher inflation, currency devaluation, and social conflict. We are beginning to see signs of all three. Inflation, while temporarily cooled through monetary tightening, remains a structural threat. It is no longer about a transitory rise in prices due to supply chain issues. This is now about fundamental imbalances in how much money is being created relative to how much value is being produced. The Federal Reserve and other central banks are trapped in a difficult position. On one hand, raising interest rates too high risks triggering a major economic slowdown or even a recession. On the other hand, keeping rates low or reversing course too soon could reignite inflation and further erode trust in the value of money. This balancing act becomes more complicated as geopolitical risks escalate and internal political polarization increases. These are the kinds of factors that create a fragile environment where small shocks can lead to large reactions. It's also important to understand that we are in a period of paradigm shift. The old tools that central banks use to manage the economy are becoming less effective. Quantitative easing, interest rate adjustments, and fiscal stimulus worked well when debt levels were lower and global cooperation was stronger. But now, with high debt, reduced policy effectiveness, and a world that is becoming increasingly fragmented, we are entering a new kind of environment. And that environment is much less forgiving of mistakes. In this new era, capital allocation becomes a matter of survival. Investors and policymakers must be more thoughtful about risk. Diversification is essential, but not in the old-fashioned sense of simply holding a mix of stocks and bonds. Diversification now means being prepared for radically different scenarios. It means thinking about currencies, inflation, productivity, geopolitics, and social stability as interconnected forces. Ignoring these relationships is what causes people to be caught off guard when the cycle turns. We are also seeing clear signs of wealth and opportunity gaps widening. This leads to internal conflict and reduces the cohesion needed for a healthy and sustainable economy. When the people at the top get richer while the people in the middle and at the bottom struggle with rising costs and stagnant wages, The result is dissatisfaction and a demand for radical change. This dynamic is not only morally concerning, but also economically destabilizing. A divided society is a less productive society. Political dysfunction and conflict are the natural byproducts of economic unfairness. In times like this, people tend to fall into one of two camps. There are those who believe that we will return to the old normal, and there are those who recognize that something fundamental has changed. The latter group is typically better positioned for what lies ahead. They study history, they analyze the data without bias, and they prepare themselves for a world that is unlikely to look like the one we've just come through. Preparation does not mean prediction. It means being resilient and adaptable no matter what scenario unfolds. The bottom line is this: we are approaching a tipping point. The combination of excessive debt, weakening productivity, policy limitations, and growing social divisions is setting the stage for significant economic challenges in the years ahead. It won't happen all at once, and it won't look exactly like any one crisis from the past, but the direction is clear. Those who understand this and act accordingly will be better off. Those who ignore the signs are likely to be surprised by outcomes they thought were impossible. Most people think of a recession as a short-term economic contraction that follows a period of growth. They picture a decline in GDP over 2 consecutive quarters, some job losses, reduced consumer spending, and then eventually a recovery. That's the conventional view, but what we're facing now is more complex. This is not just a typical business cycle downturn. What we are looking at is a deeper structural shift that has been building over years, even decades. It is important to step back and look at the full picture in order to understand where we are headed. There are moments in history when a confluence of economic, political, and social forces comes together to create what could be described as a paradigm shift. These moments are not frequent, but they are decisive. When they happen, the usual rules no longer apply, and new patterns begin to emerge. What makes these shifts dangerous is that most people don't recognize them until the damage is already done. They operate based on past experiences and frameworks that are no longer relevant. That is how people get caught off guard. We are moving into one of those periods now. The signs are everywhere. High debt levels, declining real productivity, rising inflationary pressures, global power shifts, and increasing political polarization are combining to reshape the economic landscape. These are not short-term cyclical problems. They are systemic in nature, and they will not be resolved by a simple rate hike or stimulus package. In fact, some of the tools that were used to manage previous recessions may actually make the situation worse this time around. In traditional recessions, central banks typically step in by cutting interest rates and injecting liquidity into the system. That provides a temporary boost and restores confidence. But today, interest rates have already been near historic lows, and the effectiveness of monetary stimulus has diminished. There is simply less room to maneuver. At the same time, the fiscal side is constrained by unsustainable levels of government debt. This means the playbook that worked in the past is no longer sufficient. We are entering a phase where policy options are limited and trade-offs become more painful. Another factor that makes this environment different is the nature of the inflation we are seeing. In the past, inflation was often driven by demand, side shocks, or commodity supply issues. Today's inflation is more persistent and rooted in structural issues such as supply chain realignments, geopolitical tensions, deglobalization, and labor market mismatches. These are not problems that can be fixed with a tweak in interest rates. They reflect deeper imbalances that will take time and painful adjustments to resolve. We also have to consider the global dimension of what is happening. The United States is no longer operating in a world where it holds unchallenged economic and geopolitical dominance. The rise of competing powers, particularly China, is changing the balance. That shift affects everything from trade flows and currency stability to military alliances and resource access. A traditional recession typically assumes a stable geopolitical backdrop, but in this case, economic weakness is intersecting with a more fragmented and competitive global order. That creates a level of uncertainty and risk that we have not seen in recent decades. What we are witnessing is more than a cyclical downturn. It is a restructuring of the global economic system. The rules of the game are changing. Capital will flow differently. Labor markets will adjust in unpredictable ways. Inflation will likely be more volatile, and public trust in institutions will be tested. These are the conditions under which traditional economic forecasting models break down. This is when behavioral factors like fear, loss of confidence, and political reaction become just as important as the financial data itself. When you look at past periods of great economic transformation, whether it was the Great Depression, the stagflation of the 1970s, or the 2008 financial crisis, one thing becomes clear. Those who were able to step outside the prevailing narratives and study the underlying causes were the ones who navigated through successfully. They focused on first-order principles. They asked what was really driving the changes, not just what the headlines said. That is the mindset that is required now. The problem is not that a recession might happen. The problem is that too many people are still thinking in terms of what previous recessions looked like. They are trying to solve a new set of problems with old tools and old assumptions. That is not going to work. What is needed is a fundamental rethinking of how we measure, interpret, and respond to economic shifts. It means focusing on resilience rather than prediction. It means preparing for a range of outcomes rather than betting everything on one forecast. The coming years will test not only financial systems, but also leadership, social cohesion, and the ability to adapt. That is why this is more than a traditional recession. It is a transformation. Those who understand that distinction will act very differently than those who do not. And that difference in thinking will determine who comes out stronger on the other side. The world is changing at an accelerating pace, and one of the most powerful forces driving that change is artificial intelligence. Throughout history, whenever a new technology has emerged that fundamentally improves productivity, it has reshaped economies, disrupted labor markets, and redefined competitive advantages. AI is one of those transformative forces. What we are witnessing now is not just another technological trend, but the early stages of a structural shift in how value is created and captured across sectors and geographies. If you look at how empires rise and fall, or how companies succeed or fail over time, it often comes down to how effectively they adapt to technological changes. Those that integrate new tools into their systems outperform those that resist. We saw this during the Industrial Revolution, when the ability to harness machines defined national power and corporate dominance. We saw it in the digital age with the rise of the internet and software. We are now at the beginning of the AI age, and the same pattern is unfolding again. The reason AI matters so much is because it is not just about replacing tasks. It is about improving the way decisions are made. AI enhances pattern recognition, speeds up analysis, and uncovers relationships that would otherwise be invisible. In the realm of investing and business strategy, that is a game changer. It allows firms to anticipate trends, optimize operations, and allocate capital more intelligently. In an increasingly complex and competitive environment, those capabilities are not luxuries. They are necessities. From an investment perspective, the key is not simply to invest in companies that are labeled as AI firms. The label itself is not what creates value. What matters is whether the company is integrating AI in a way that enhances productivity, builds defensible advantages, and creates sustainable growth. Many businesses will talk about AI. Far fewer will actually use it to transform their models in meaningful ways. The goal is to distinguish between those two groups. There are certain industries where the impact of AI will be especially profound. Healthcare is one example. The ability to process large volumes of data, identify patterns in diagnostics, and customize treatments based on individual genetic profiles has the potential to dramatically improve outcomes and reduce costs. Another example is finance, where AI can be used to manage risk, optimize trading strategies, and identify market inefficiencies. Retail, logistics, cybersecurity, and education will also be reshaped by AI, though in different ways depending on how value is delivered in those systems. It is also important to understand that the benefits of AI adoption will not be equally distributed. Companies with strong data infrastructures, leadership that understands technology, and cultures that support innovation will be positioned to benefit disproportionately. The gap between the winners and the losers will grow wider, not narrower. This means investors need to be more selective than ever. It is not enough to follow the broad trend. You need to understand how the technology is being implemented, what advantages it creates, and how defensible those advantages are over time. In environments where economic growth is uncertain and traditional macro indicators are flashing caution, AI-linked productivity improvements become even more valuable. If you cannot rely on rising demand to drive growth, then you must find ways to become more efficient and more intelligent in how you operate. AI provides that pathway. It enables a kind of growth that is not dependent on external tailwinds. It is endogenous. It comes from within the system. One of the principles that history teaches us is that periods of disruption create both danger and opportunity. If you are unprepared or misinformed, you risk falling behind quickly. But if you are thoughtful, diversified, and aligned with long-term trends, you can emerge much stronger. Investing in AI is not about speculation or hype. It is about aligning your capital with the direction in which the world is moving. That requires studying the data, understanding the structural shifts, and positioning accordingly. Another point to consider is that AI is not only about technology. It has cultural, ethical, and regulatory dimensions as well. Governments will play a significant role in shaping how AI evolves. There will be debates over privacy, labor displacement, intellectual property, and global standards. These issues will influence which companies thrive and which face headwinds. As with any powerful technology, the broader ecosystem around it will shape its trajectory. Smart investors will not just look at the tech, they will also assess the surrounding environment. What is happening now with AI is similar in many ways to the early days of the internet. At first, most people misunderstood its significance. They thought of it as a niche tool or a passing trend. But those who looked deeper, who understood the implications for commerce, communication, and infrastructure, positioned themselves early and reaped the rewards. We are at a similar point with AI. The headlines and the noise are loud, but the real signal lies beneath. The winners will be those who can filter that noise and see the long-term truth. Strategic investment in AI is about preparing for a future that will be very different from the present. It is about asking the right questions, studying the right data, and building a portfolio that is resilient, adaptable, and positioned for what is coming. In a world of growing uncertainty, few things are more important than that. When navigating uncertain environments, the two most essential principles that consistently stand out are diversification and productivity. These are not just tactics or tools. They are foundational elements of long-term success in any system. Whether you're managing a portfolio, running a business, or overseeing a country's economy, if you ignore either one of these forces, you expose yourself to unnecessary risk and limit your potential for sustainable growth. Diversification is the closest thing to a free lunch that exists in finance and economics. It is rooted in a very simple idea: you do not know what the future will hold. No one does. When you accept that reality, your objective becomes building resilience rather than relying on prediction. The way to do that is to hold uncorrelated bets. By spreading your exposure across different assets, industries, geographies, and time horizons, you reduce your vulnerability to any single point of failure. It's about balancing risks so that the downside of one part is offset by the upside of another. Throughout history, the people who have endured turbulent periods best were not those who correctly predicted every move. They were those who had structured themselves in a way that allowed them to absorb shocks, adapt quickly, and stay in the game. They were diversified not just in assets, but in thinking. They were not overexposed to any one idea or ideology. That is a critical difference. Diversification is not about owning more things. It is about understanding the correlations between those things and ensuring that no single event can take you out. At the same time, diversification alone is not enough. You also need productivity, because over the long term, the health of any system depends on its ability to produce more than it consumes. Productivity is the engine that powers everything else. It is what allows wages to rise, wealth to be created, and standards of living to improve. Without it, any gains from diversification or policy intervention are temporary. They might smooth out short-term volatility, but they do not solve the underlying equation. The key question then becomes, how do you improve productivity? The answer is not as simple as working harder. It is about working smarter. That means investing in education, infrastructure, innovation, and technologies that allow people to do more with less. It means creating systems that encourage creativity, discipline, and continuous improvement. And it means removing obstacles that prevent resources from flowing to their most efficient uses. In both businesses and governments, misallocation is one of the greatest hidden costs. When capital and labor are stuck in unproductive places, growth stagnates and debt becomes harder to manage. Another often overlooked truth is that diversification and productivity are linked. If you are overly concentrated in one sector or one strategy, you limit your exposure to new ideas and innovations. You miss opportunities for improvement that come from learning across different domains. Cross-pollination of knowledge is one of the drivers of breakthroughs. For example, advances in computing have revolutionized everything from agriculture to medicine because those sectors were open to outside tools. The more you diversify your perspective, the more chances you create for productivity to increase. This principle also applies to investing. If your portfolio is built solely around past winners or a single macro theme, you are effectively betting that tomorrow will look like yesterday. That is rarely the case. The world changes, regimes shift, What worked in one environment may not work in the next. The best investors understand that. They structure their portfolios not around certainty, but around probability and resilience. They diversify across economic environment, rising inflation, falling inflation, strong growth, weak growth, and position themselves to do reasonably well in all of them rather than trying to maximize in only one. In today's world where debt levels are high, geopolitical tensions are rising, and technological disruption is accelerating, both diversification and productivity become even more important. You cannot rely on static assumptions. You cannot afford to be overconfident in any one model or forecast. Instead, you need to be humble about what you do not know and thoughtful about how you prepare. That is what real diversification looks like. It is not passive, it is active, it is dynamic. It involves constantly questioning your exposures and updating your view as new information comes in. At the same time, productivity must remain the goal. Because over time, only systems that produce more than they consume can grow sustainably. You can borrow and stimulate in the short run, but if you are not improving productivity, you are simply shifting problems into the future. Eventually, the bill comes due. That is why the most resilient portfolios, the most successful organizations, and the strongest nations are those that combine broad diversification with a deep commitment to productivity. The best preparation for an uncertain future is a structure that can weather surprises and a process that continuously improves. That combination has stood the test of time and will continue to do so as the next cycle unfolds. In the realm of investing, the most successful strategies often stem from a deep understanding of economic cycles, geopolitical shifts, and technological advancements. As we approach 2026, it's imperative to identify companies that are not only resilient but also poised for growth amidst the evolving global landscape. One such company is Alibaba Group Holding Limited. Despite facing regulatory challenges in recent years, Alibaba has demonstrated a robust ability to adapt and innovate. Its expansive e-commerce platform, coupled with ventures into cloud computing and digital finance, positions it well to capitalize on China's growing middle class and increasing digitalization. The company's strategic investments in logistics and international markets further enhance its potential for sustained growth. Another noteworthy contender is Baidu Inc., often referred to as China's equivalent of Google. Baidu has been at the forefront of artificial intelligence research and development. Its advancements in autonomous driving technology and AI-powered services indicate a strong trajectory in sectors that are expected to redefine industries in the coming years. Baidu's commitment to innovation and its strategic partnerships underscore its potential as a long-term investment. Tesla, Inc. also merits attention. While the electric vehicle market becomes increasingly competitive, Tesla's continuous innovation in battery technology, energy storage solutions, and autonomous driving capabilities sets it apart. The company's global manufacturing footprint and brand recognition provide a solid foundation for future expansion. As the world shifts towards sustainable energy solutions, Tesla's integrated approach to clean energy and transportation could yield significant returns. In the technology sector, Microsoft Corporation stands out. Its diversified portfolio, encompassing cloud computing, enterprise software, and gaming, offers multiple revenue streams. Microsoft's Azure platform has seen substantial growth, catering to the increasing demand for cloud services. The company's strategic acquisitions and investments in artificial intelligence further bolster its position in the tech industry. Alphabet Inc., the parent company of Google, continues to be a dominant force in digital advertising, search, and cloud services. Its ventures into emerging technologies, such as quantum computing and healthcare, indicate a forward-thinking approach. Alphabet's strong balance sheet and commitment to research and development make it a compelling choice for investors seeking exposure to innovative tech enterprises. Apple Inc. remains a stalwart in consumer electronics and services. Its ecosystem of products and services fosters customer loyalty and recurring revenue. Apple's investments in augmented reality, health technology, and financial services suggest avenues for future growth. The company's consistent performance and adaptability to market trends underscore its potential as a reliable investment. When evaluating these companies, it's crucial to consider not only their current performance, but also their adaptability to changing economic conditions and technological advancements. Diversification across sectors and geographies can mitigate risks and enhance the potential for returns. By focusing on companies that demonstrate resilience, innovation, and strategic foresight, investors can position themselves to navigate the complexities of the global economy and capitalize on emerging opportunities. In conclusion, by understanding the deeper economic currents and making informed investment choices, we can navigate the challenges ahead. Let's approach the future with strategic insight and confidence.